could start, Tracy, with the status right now of the Canadian housing market.
I think it's complicated. There's always a lot of information when you do a 30-day look back at where the national housing market is, and then I'll get into where we are locally here in Kitchener-Waterloo. So when we're looking on a national average in Canada, the average price point of a home is $676,000. The price point actually went up marginally, like 1.8%, which is good to see, and that's month over month. But when we do a full year look back, actually values still went up over 1%. So some people could say we're slowly seeing a recovery, but I think it depends on where you're looking at from province to province. If you're looking at BC and Ontario, I'm tending to find both those provinces are struggling from a housing perspective. They've definitely had some fluctuation of values declining, especially over the last 3 years, because we had that hockey stick momentum of values going up in 2021 and part of 2022. So there's been a correction, and that correction has impacted a lot of people's affordability. We're still at a higher price points in both of those provinces. So right now we're seeing a lot more inventory on the market. A lot of people would say it is definitely a seller's market, where when we're looking at in Alberta and we're looking at Saskatchewan and Manitoba, and then way out east in Newfoundland, part of Nova Scotia, and then in Ontario, if we're looking at Montreal and Quebec, they are majority of a buyer's market because affordability is a lot lower there. So when you're looking at a national average, I think it looks different in those areas because there's a lot more people migrating into those areas because of affordability. They are able to still maybe work from home or maybe find work there because economically it's better in those provinces. And so you're seeing a bit of, I'd say migration into these areas over the last probably 30 to 60 days. I'm seeing quite a bit of people move into those areas. But we're still seeing, where the majority of the national average brings down or brings up where values are at, it tends to be Ontario and BC, and more importantly, Ontario, because it covers a bigger geographical area. So I would say that the market is challenging depending on the area that you're in. We're seeing that it's taking people about 31 days to sell a house on a national average. That's not bad. I mean, we saw that, statistic about 5 years ago as well, right? So people are still moving. It's just taking longer for people to move. But they're comparing it to where it's been so quick and people were moving in, listing their house and selling in 7 to 8 days. So again, it depends on your house, the type of house you're in, where you're living, what province you're living in, how the market is doing, right? So it's hard to really take that national average and put a label on where the housing market is. But I would say that, speaking to a lot of real estate agents across the country, real estate agents are as busy as they want to be. It's the effort that they put in when speaking to their clients, educating them more, providing more value, being able to really move the needle on where people are at, connecting them with mortgage professionals, accountants, lawyers, to make sure that that whole piece of, when a client's looking at buying, they really truly understand where their opportunity is. Because in this market, I always say when there's challenges, there's opportunities. And there's definitely opportunities for people that want to buy in this market. I always go back to when my husband and I bought our first home. When we bought our first home, it was in 1996. We didn't think about back then where inflation was, where the economy is. We just wanted to buy a home. And we had to make sure we had a stable job, we had good credit, and we had that down payment. And back then, you couldn't even do just 5% down. We had to have 10% down. So this is where I think we're getting away from it. There's a lot of information that's out on social media, and I'm finding that people are getting away to, okay, can you buy today? If you are a first-time home buyer, do you have the funds? Do you have a stable job? Where are you at with your credit? Did you speak to your mortgage professional? And then let's look at where you can buy a home. Let's tune out the noise of where we are, from an economic perspective, because at the end of the day, owning a home helps bring equity to your overall net worth. It helps put a roof over your head. It helps, build that family stability that you want in owning a home and that future growth of home ownership. So that's where I think people have to kind of really dive back into that.
And for a lot of people, it's just the dream. It's what they want. It's the
100%
home
it
ownership.
is.
And I feel like a lot of people maybe get muddied in all of the different variables. And I'm talking, you'll hear about the Bank of Canada, immigration, new
Yeah.
builds. I mean, a lot of these things vary and adjust the prices, right, in your
Yeah.
area,
Yeah.
and maybe single detached versus condo.
100%. I think that, I mean, when you look at it, when we first bought our house, my husband and I, we didn't buy a single detached home. We bought a semi-detached property. You have to, take time when you're buying a home and not go to the maximum. You could have a goal, which is always great to have, of that detached house, but it doesn't mean you have to have it right away. And if it is something that you want to do right away, you might have to look at your financing a little bit different, such as a mortgage helper. And I'm seeing a lot of that right now. So we're bringing either generational homes into the mix right at the beginning, where families are coming together to be able to qualify for a detached home, or we're looking at, individuals or couples buying with friends or buying with other
Interesting.
investors, or
Okay.
buying with other investors to be able to get this property, because they know, moving up, home after home is going to take longer than it traditionally is or has been, and they want to be able to buy into that market today because the opportunity is there today. We are in a lot of areas, and let's talk about Ontario or even here in KW. It is a buyer's market. So you can negotiate your price point. You can go in with conditions of financing, home inspection. That property that you're looking at as detached house is probably around the same price as it was 5 years ago, because we had this hockey stick of values going up, and then we've had these reduced price points. So people can get in now knowing that eventually values are going to start going back up. Like, let's face it, we still don't have enough supply for the amount of population growth that we have in Canada. And some could say, and I do say right now, okay, in this market, as challenging as it is because of inflation, because of higher interest rate, because of finance and government policies right now, and it's hard for people to qualify for mortgage financing, it's not about supply anymore. It's about affordability, right? But the thing is that we still don't have enough supply for the amount of population growth we have and where this federal government wants to go with population growth. So ultimately, values will start going back up. And on average, in a normal market, taking out what's happened the last 3 years, or let's say even the 5 years, values go up 3 to 4%. Okay, on residential houses. So we'll eventually get back to that. And we might see these upticks of 5 to 6%, depending on the type of home you have. But traditionally, a detached house is where you see the most growth in value over time. So if people are looking at, okay, I want to get that detached house today because it's the same price as what it was 5 years ago, and I know values are going up, maybe I need to look at that property a little bit different and look at either other investors that want to buy it with me. And there are programs out there now that can help you do that, where you might not even know that investor. So there's programs out there where you can have another investor come in under these programs and you are able to take a share of ownership into that property and eventually be able to buy out that investor. Or you do have friends. So I have people that come together as couples and buy a detached home, and they split the home in different levels so they can live. On one's on one floor, one's on the bottom, and they have separate entrances so that it's a legalized duplex. And then they live in these properties, and then it gains actually more value because over time those properties are going to be more desirable because we're going to see more generational homes. It's expensive to live in Canada. It's expensive to live in Ontario. So these type of properties, it's going to be harder for people to qualify. It doesn't matter if interest rates come down. Overall, it's harder in Canada to be able to own a home. And so looking at these different programs that are out there, looking at, proactively where values are going to go, taking the opportunity now to buy a detached home is not a bad thing to do, as long as you can afford it and you make smart financial decisions.
It's interesting you brought up some interesting options about the potential for you. Somebody may think, well, wait a minute, if I can't as a single person or a couple afford, they may not know about the other options that perhaps getting in touch with you, you could give them some other options.
And I think you made such a good point, Mark, because I think nowadays people don't know what the opportunities are out there. Just like AI is evolving so much, so is the mortgage financing world in Canada. There are so many new programs that are coming out to help people with home ownership. And home ownership looks a little different than it used to be. It's not the traditional way of, and you can still do this, buy a home and you own it yourself or you own it as a couple. But if it's challenging for a lot of people to be able to buy, a first time home buyer now is age 34. And I think that's even increasing because it's just so hard as an individual to buy a property nowadays. When you're looking at, I mean, I look at even the average home in KW is $753,000. When you're looking at what you need to be able to qualify for that from an income, you're almost at 200,000. You know, what single income in Canada, if you're looking at individuals, are making 200,000 right from the
Exactly.
get-go? Like that's, you know, most of them as a single income just getting into homeownership are usually making around 70,000. They're not going to qualify for this. So
There's options.
yeah,
There's
there's
options.
lots of options out there.
Okay.
So locally, it was actually quite interesting over the last 30 days. We saw from every different type of property, detached townhomes, semi-detached, and condos, values all went up over the last 30 days. So more activity. And traditionally, if you look at it in the housing market, we do tend to see October a busier month than the housing market. A lot of people want to look at buying that property or selling by that point so that they're settled into what that new home looks like before the end of the year, like end of the year,
Okay.
and entering into, you know, 2026. So I tend to see, you know, I've been doing this a long time, geez, like 26 years. I tend to see that doesn't change no matter how challenging the economy is. So October was a busy market from a housing perspective. We have more first-time home buyers actually overall in Canada, and we're seeing that. So I saw a lot more people reaching out to my team locally, looking at buying a property that were sitting on the sidelines, and it could have been because we were waiting on that Bank of Prime announcement where, you know, Bank Canada was going to increase or decrease Bank Prime or keep it the same. And people were also on the hope of, you know, fixed rates coming down so maybe they could qualify for more. So we saw a lot more activity. Detached homes, which is one that I really hyper focus on when I'm looking at the KW market. Values went up just slightly over 1%. So the average detached home price is $858,000, which is still really good right now, considering where it's been. Like we saw, you know, 2.5 years ago, a detached home over $1 million.
Yeah.
So when you look at it, the opportunity is there for people to buy these homes because it's, you know, interest rates are up, but actually I've done the comparison with a value of a detached home in KW over $1 million, and with rates 2% lower, your mortgage payment is actually less right now because you're buying this property, you know, almost $200,000 less than you would have paid,
That's
right?
substantial.
It's
Yeah,
substantial. So your
absolutely.
mortgage balance is less. Your interest rate, even though your interest rate's gone up, your mortgage balance is a lot less that you're paying your actual interest rate on. So that's where people have to see the numbers to see that where it actually works. Where I find people are struggling is qualifying. But what I'm seeing is that people have the down payment, so they have the 20% to put down on these detached homes. So we're able to look at these programs within the financial side where we can increase the amortizations to 30 years. We could look at extending ratios, which is their TDS, is just their total debt ratios and their gross debt ratios so that they can qualify for these properties. And interest rates are still coming down. So this is why we're seeing more activity, especially in October. When I look at the condo market, values actually went up 2%. So values in the condo market are 442,000 on average, which is really good. You know, for a condo and a first-time home buyer, I think it helps people get back into that space. So we're seeing more people enter into that, and we're actually seeing because there's more inventory out there. The condo market, you can look at low-rise condos and a two-bedroom, and you're able to get those at like 350, $400,000, and that's a great starter home, right, for, you know, a couple or an individual to be able to get into, and it's a price point that is affordable. So the average market days on market for a property to get listed and sell is about 32 days. So that's compared to last year, we were at 28 days. So it takes a little bit longer, but not much. And I would say it depends on the property. Like my team has sold properties recently in the last 30 days within like 7 days from the time it was listed to sell. So when I look at that, I really take a look at the neighborhood. I take a look at the type of property. I also think it really makes a big difference how you showcase that home. Staging makes a big deal. How that property looks, so visually when people come in to take a look at it, they see the space in a different light, right? It really does make a difference. People want a home that's, I think, not going to take a lot of funds to be able to do some renovations or do some repairs. They want to look at it as if they were moving in ready, right? Maybe even just with the furniture in. So we're able to showcase these properties, and I've seen it. And these properties were, some were detached, some were townhomes, and we're able to sell them in a short period of time. And I've seen that across the board with realtors. So I think that inventory is abundant in Kitchener Waterloo, but I also think that values are reasonable to where they've been before, and interest rates are coming down. So I do have some optimism in the KW area for some more uptick on people being able to afford home ownership. I think where the challenge comes into is tariffs and
Yeah.
the struggle of employment. That's where employment, I think, is the big question.
Tracy Valko, Valko Financial is here. So that's where I was going to go with the fact that there seems to be this instability almost every day when you turn on the news, and that has to do with economic things as far as the economy and inflation. I guess those things are variables and stressors people concern themselves with.
And I think it's because we have so much information online on social media. People are looking at TikTok for education. That's great. You got to be careful what you're looking at. You can get overwhelmed. People are looking at it before they're even putting their first foot out of their bed. And so they're making decisions, or their mindset is set a certain way. And we have to remember, a lot of social media is about the chaos out there. It's about what's going to drive that viewership. And it tends to be a lot of the negative out there and not of what the opportunity is. Yes, inflation's challenging. We all know that. And we can see it in our pocketbooks. We can see it when we go to the grocery store. It is challenging. But at the end of the day, it was challenging, when I bought my first home, over 30 years ago. It was challenging, right? But we didn't have all the social media noise out there to really, upset our mindset every day. We wanted to own a home. And so I think that that's where sometimes I have to have deeper conversations with people now to provide more education and clarity and calmness into making some decisions out there. So, but ultimately, you have to make sure you've got employment. I
Sure.
mean, this is the thing. You're not going to buy a house if you know you've got unstable employment, or if you're self-employed, which a lot of people are in Canada, and they could be struggling in the type of industry they're in, depending on what's happened over the last 12 or 24 months, and especially if it's impacting, specifically tariffs have impacted their, what their livelihood is. So, we've seen it. Like, I've got the stats here right now. We've had over 100,000 job losses in the last 9 months in Canada in different sectors. And it's not just one sector in particular. There's been sectors that are, from AI technology to manufacturing's been a big one, right? That has it. Amazon's laid off over 30,000 people globally. That's affected us here. And then the financial sector in Canada, we've had some major layoffs recently. One of the banks laid off 8% of their staff Canada-wide. So that information's on social media. That's also affecting people's mindset when they're making decisions. And then, they're questioning their own jobs, right?
Mm-hmm.
And so that's where, as a mortgage professional, it's not just about offering a rate to a client. It's not just talking about a mortgage product. It's sitting down and really understanding the client. It's the KYC. Know your information, know your client, and understanding where their income's at, what job they're at, what education they have, and what is their longevity of how they want to see home ownership. Are they looking to just come in for a short time? Are they looking as an investment? Are they looking at it for longevity of home ownership? Is there an opportunity to be able to maybe bring multiple people into their property? How many people are actually on the mortgage to offset payments in case of job loss? And then looking at mortgage products and mortgage insurance to be able to look at ways to protect your mortgage payments and to protect you in case of job loss, because there is insurance out there that can help people and protect their mortgage in case they end up losing their job. So I'm finding, as a mortgage professional, you always have to level up your education, have a deeper conversation with your clients, potential homeowners, or even existing homeowners. I talk a lot about my term this year, which is called right sizing. So it's right sizing to your income, right sizing to what your affordability is now, and what makes sense for you with holistically where you're at with your financing, your mental wellness, your family wellness. So it's not about just owning this big house. It's, what needs to move the needle today. That doesn't mean in 5 years we can't change that. because things can change. The market's going to get back to some normalcy at some point. It's just going to look different. And we could look at getting you into that starter home again. We could look at, right sizing you into a property that makes sense to the affordability today. But that doesn't mean you can't move up down the road. Remember, values do go up. On average, 3 to 4% in Canada. It will give you the equity to reposition yourself down the road. And this is where people have to look at opportunity as not just short-sighted into the hour right now, but down the road, because homeownership is a long journey investment. It's not a short win, just
Well
like
said.
most investments today.
Well said.
And you're so right. A lot of people have a misunderstanding about the Bank of Canada and what that actually means, but people are moving and making decisions on home ownership on these rate announcements, which traditionally they haven't been. It's super interesting because leading up to, I find, the week of the Bank of Canada announcement, I find the industry is pretty quiet from a lot of people having conversations on buying a property or making decisions if they're coming up for renewal. And then the Bank of Canada announcement happens, and then it gets super busy in our industry. So
Isn't
it's
that
been,
interesting?
yeah, it's been
Wow.
super interesting on that. I speaking to a lot of mortgage professionals across the country. The real sentiment is people and Canadian homeowners or potential buyers are making decisions because they think the Bank of Canada announcement is going to change their affordability. And that's not necessarily true. It is for people that are holding existing variable rate mortgages. It does affect where their interest rate is, ultimately where their payment is, and how much they're paying to the bank on interest and principal. So that it does make a big difference on, or it makes a decision if you're coming up for renewal and you want to look at, okay, do I take a fixed rate right now? Do I look at a variable rate? What's in my best interest? People obviously will want to know what the Bank of Canada is saying and what the future forecast is on rates. But from a qualifying perspective, it really doesn't make a difference because fixed rates are qualified very different than the bank prime rate. The bank prime rate is the metric that the Bank of Canada uses to determine where bank prime is, and it's based on the overall Canadian economy, where we're at with inflation, where we are at with, food prices, gas, where we are at with, the state of our economy. And that's where the Bank of Canada will make the decision because lower bank prime tends to help move our housing market better. But fixed rates are based on the US market and it's based on the 10-year Treasury. The 10-year Treasury in the US is based on the US economy. And if the US economy is doing well, then the 10-year Treasury will move when that moves, or if it's not doing well, the 10-year Treasury will come down, and that affects our Canadian 5-year bond yields, which affect our fixed rates. And so even though you can look on a graph and they correlate very similar, bank prime and fixed rates, they don't necessarily move at the same time. So I find that day that the Bank of Canada makes an announcement, my team, myself, and probably a lot of mortgage professionals across the country get calls from their clients saying, hey, did my fixed rate come down? Or can I qualify now more because bank prime came down? And that is just a longer conversation of continuing to educate clients. And so what I do find is that mortgage professionals and even real estate professionals are posting that bank prime came down, but they're actually posting the bank rate. So the bank rate came down. So we did see 0.25% last week from the Bank of Canada. So that's the fourth reduction we've seen on bank prime, which is great news. So bank prime rate right now is at 4.45%. And that is the rate that we pay as consumers, as homeowners, if we are in a variable rate mortgage or if we hold a line of credit where we've got money outstanding on it from one of the banks. But then there's also the bank rate. So the bank rate is what the government uses for the banks to be able to lend money to one another. And then they bonus that rate usually by 2 or 2.5%, which is called bank prime. And that's what we pay on because the banks need to make profit. So when a lot of people like mortgage professionals and real estate agents, they'll post actually the bank rate at 2.25. So we get clients going, oh my God, my rate's 2.25. Now I can qualify for this. That's not actually what it is.
So the banks
right?
don't always pass on the full rate reduction.
Yeah. So they do pass on the rate reduction, the 0.25%, but we have to remember that we pay at a higher rate, right, to the bank, right? So we did see a 0.25% reduction, which is great news for existing homeowners. Keep in mind that 0.25% What that equates to is about a $15 reduction on every $100,000 that you owe on a variable rate mortgage or a line of credit. So, which is great news. It also means that you might want to start considering taking a variable rate mortgage. And we're starting to see in Canada this movement of about 42% of Canadians moving into the direction of actually taking a variable rate mortgage again, because we're seeing this momentum of bank prime coming down. In fact, in the last 3 years, we've had 10 decreases in bank prime.
10?
10.
Wow.
So we're not, and that's where people aren't really seeing that because they're so caught in the chaos of where the economy is. But we've had some massive decreases in bank prime. But you can tell it still hasn't moved the needle for people, right, from home ownership because values have gone up so much in Canada. So the forecast into 2026 is we'll still see bank prime come down. It's hard to forecast how much. There's pretty much a split out there with economists that will see a full 1%. I'm in the middle that we might see a half to 3/4, depending on how deep we go into a recession. Our recession is going to be dictated by how much unemployment we have in Canada and what's happening with tariffs, and then how much this government's going to inject to help our economy and boost it back up again, which today was the federal budget. And so there's lots of good, conversation. I mean, there's a lot of injection of government money into the federal budget, which is inflationary. And inflation doesn't necessarily move the needle on bank prime coming down. So it's very complicated, you can see, right?
Well, and you brought up a good anecdote earlier when you suggested that anytime someone looks into home ownership, it's not like they should be looking to the past to it was ever ideal. As you mentioned, when you first purchased, there's always things that may get in the way or things to consider. But for a lot of people, the best time is in your life if you can afford to do it or look at the options, right?
Absolutely. And I think that's what you got to do if you're buying. You got to tune out the noise and put the oxygen mask on you and your family and see what makes best sense for you to buy in this moment, right? What makes sense? Can you do it? Is your financing solid? Is your credit good? Is your job stable? Do you have down payment? Do you have the buffer also for the housing expenses? Do you have 6 months of retained earnings for your mortgage, for your cost of that house in case something does happen? These are the metrics that matter when you're buying a house. If you don't have all that, I wouldn't recommend you're buying right now. Like, as a mortgage professional and in the real estate industry as whole over the last 26 years, I've never told someone to move the needle if they don't have this in place, because it affects you in so many ways, right? Financial strain and struggle is not fun. No one's ever going to sit there and go, yay, it was great. I mean, it's big learning lessons for people. And that's why I'm using the term right sizing, because I'm trying to look at it in an optimistic light for people. Let's right size to where you're at right now. Let's learn from the lessons of what's happened if they've come to us. And there's a lot of people that are delinquent right now in Canada on their mortgages that need help. But here's where it matters on bank prime. It matters if you're coming up for renewal, if you're those 2.1 million of mortgages coming up for renewal, which is the most, by the way, in Canada ever in the next 12 months in 2026, coming up for renewal in Canada, where your payments are potentially $300 to $400 more, if not even more, than where that you were 5 years ago. I've got people coming to me where their rates were 1.5%, and they're coming up for renewal now. Now, the good news is fixed rates are coming down, and we're seeing rates now under 4%, but still a 3.89% interest rate compared to 1.5%. Your payments are going up. Now, there's lots of ways to restructure your mortgage and get that payment down again, but you have to have the conversation. Don't get stuck in the chaos. But this is where people need to understand where interest rates are at, need to understand where bank prime is, because they need to know how to make a better decision for their financing that could potentially save them thousands of dollars and not just locking in out of panic and chaos.
So to prepare for potential renewal, are there steps people should take to talk to you, to ask the experts?
You just said it right, Mark. Absolutely. There's not an earlier time than now to have the conversation to see where you're at. I have people that are contacting my team a year out on their renewal. Where am I at today? What am I looking at? Give me on a high level where the market is, where the economy is. Can I talk to you about where I'm at with my employment? Let's talk about where I'm at with my credit. So is there ways that I can actually correct it or make it better so I can be in the best situation a year from now? That's being proactive, and that's smart financing.
Are banks more flexible? with
It's
refinancing?
it's interesting because I'm finding what's happening is the federal government's making changes and restricting the banks to be able to have clients that have over leveraged debt. So there's this terminology that's coming into place called LTI, which is loan to income. So it's a loan to income program that is coming into place by the federal government, and it's basically a rule that's going to hinder people's ability to be able to qualify for mortgages if they're over leveraged with their income or their debt. Absolutely. Education's key right now.
And
Well, it always has been, right?
Well, it always has been, sure.
Yeah, yeah.
But in talking to an expert like yourself, now we left off, you were talking about the LTI.
Yeah. So the LTI is right now, like it's a proposed policy that the government is looking at changing to qualify people in purchasing properties or their existing homes. And it's to eliminate the stress test. So the stress test right now has been in place to be able to look at a responsible way to qualify existing homeowners and homeowners, new homeowners, in case of a rising rate environment, because we've had such low interest rates in the past, down to like 1.5, right, on a 5-year fixed rate at some point. So it was to have people qualify 2% higher than the interest rate that they're actually getting on their mortgage. So let's go back to when rates were 1.5, you would have to qualify at 3.5 in case rates went up. That metric was changed during the course of interest rates being so low. So the stress test actually evolved to either 2% higher than the rate you're getting, or you would have to qualify at the higher of the contract rate. So the contract rate right now is 5.25%. So what that would mean is that instead of you qualifying at 3.5 on that 1.5, you actually have to qualify at 5.25.
Whoa,
Yeah.
That's a big difference.
It's a big difference.
Yeah.
And it's, as we know, has affected people's affordability. This is why we're seeing more parents going on as co-signers or people adding more of a down payment to be able to qualify for these. So this is where now we've seen this evolution of interest rates go up, where if an interest rate right now, let's say on a uninsurable, which is you have 20% down and buying a home and the rate's 4.5, if you're qualifying on the stress test, you actually have to qualify 2% higher than that, which is 6.5. So that's higher than the contract rate of 5.25, which means you still have to qualify at 6.5 because it's the higher
options,
up.
I would
It still
imagine.
reduces
Yeah.
options. So there's an argument from us as mortgage professionals and in the banking industry, like we got to look at adjusting the stress test, like maybe changing it to 1% instead of 2% higher, eliminating it in this environment. So the government's looking at this rule, proposing it as this LTI. So the LTI is instead now looking at your income. So your income and the maximum mortgage amount you're allowed is 4.5 times your income amount, your annual income amount. That's it. So for example, let's say you make $100,000. 4.5 times your income is $450,000. That's what you're capped at. That's how much you qualify in your mortgage amount. So if you're buying a property, let's say for $550,000, you've got to come up with $100,000 down because the maximum you'll qualify for is $450,000.
Right.
Right? Now that's not including how much other debt you have. Okay, so if you have car loans and so if you have car loans and that's going to bring down that LTI income as well. So it's actually doing a disservice by this proposal that the government's looking at. It's going to, instead of looking at ways to help people with homeownership, it's now looking at ways of making it more challenging. So what's the solution in this? The solution is if this does come in, which more than likely it looks like is coming in 2026, people are going to have to look at qualifying into what we call alternative space. And this is what I'm seeing this year. This is a space in the mortgage brokerage industry where we have lenders that look at increasing your gross debt service ratio or your total debt service ratio. So that means that we can go over and above this LTI. We can look at these policies and getting exceptions, but you pay slightly higher interest rates. You pay a lender fee, potentially a broker fee on it as well, and it's shorter terms. It's 1 to 3 year terms. And I'm starting to see more people, even with the stress test right now in place, having to go into the alternative space because, let's face it, affordability is tough right now. And the average mortgage amount has increased, right? It's increased substantially. People have more debt. we're consolidating more debt at the time of renewal or even before renewal to help people make ends meet and stay in their property while we navigate these times. And people are looking at more of that alternative or even private space. And I'm seeing, as in the mortgage industry, more lenders getting into the alternative space. Even the banks are looking at these options, and I'm seeing more private entities come into the private space because it's a growing niche. It's probably just a growing momentum of financing that we need to have in Canada for home ownership, because having a bank mortgage is really tough to get to qualify nowadays. And these proposals that are going to come in place are going to be make even tougher for people to fit into that A box anymore.
Now, you made an interesting point about that. We don't always think about existing debt, which is a variable. Can you improve your credit score before renewal or refinancing? Are there things and steps people can take?
You can, absolutely. I've seen people repair their credit within 30 to 45 days, just being able to credit coach them. And it's really taking a look at your Equifax, even your Credit Karma report, like wherever you're looking at getting that, and you should be looking at that on a monthly basis. Taking a look at where you're over leveraged, maybe on a balance on a credit card, making sure that, let's see what funds you have that you can put towards paying down that balance. Making sure that you have that down. Even if you could bring it 30% lower than what the limit is, it helps increase your credit score. Or if you can pay off your balance in full, so we can get that credit score bumped right up within 30 days in case you are coming up for renewal. We're looking at financing options for you. It can help you get into a different product. On the mortgage side, better interest rates, right? Saves you thousands of dollars. So coaching people and letting them know where they're at, and then making sure they don't default on their when their payments are due on their credit. Because if you have derogatories, which is negative, delinquent missed payments on your credit bureau, it will affect your overall credit score, and you might not be able to get that better interest rate. And I've seen on renewals, these banks will look internally at your credit. They will see if you're over leveraged with credit. They will grade your credit within that institution that you have your mortgage renewal with. Your interest rates that you're offered and your terms will be restricted or be offered higher. And in the last week alone, I've seen 3 clients come to me, and their rates were over 6% with one of the major banks, and they were only offered 2 rates. Now, it doesn't mean that that client is done. It doesn't mean that they have to renew at that, because I actually pulled their credit. Their credit wasn't actually too bad. They were over leveraged, but they had the equity in their property. We consolidated their debt. We moved it to another lender with best interest rates and consolidated it. So people could say, well, why didn't my existing lender or bank offer me best rates? Because you as a consumer, you as a client of that banks, did not like the way that you were positioned with your credit. You going to another lender, you're a new person. But here's the thing, like, I really talk to people about stop over leveraging, right? Let's look at financial responsibility. Let's look at, okay, now I'm consolidating your debt. Let's make sure you're managing it so you're not in this position again in 5 years when you come up for renewal.
I love it that you're like a trainer, like it's strategy. I almost feel like you're the person that's like, I'm not giving up on you.
Yeah.
There is
exactly.
a way we could work around it. And again, that's through your knowledge, which I think is just wonderful. Now, your knowledge available through the website by contacting valkofinancial.ca, and you can contact them by phone 519-745-8019. There was a wealth of knowledge just when I went to your website, valkofinancial.ca. But I also know that you take on events, and there are things that people should know about. What do you have coming up?
So we have hosted all year a series of webinars between the financing side and how to navigate on the real estate side. We have an upcoming webinar that is on November the 18th, and it's called The Buyer's Blueprint. So it's everything you need to know about buying in today's current market. So if you want to take a look at this, I would highly recommend that you sign up for the webinar. We've got some great information, some great tools available to help people navigate not only this year, but into next year as well, and win with your financing. And you're able to register for this. It is a free webinar.
It's free, okay.
Absolutely. So it's on any of our social media platforms, and it's on our website as well.
Well, I sense there may be people that are, dare I say, embarrassed or shy about meeting for fear that you're going to say, oh, no way do you qualify. But I get the sense that you've seen so many different scenarios that you can work with people in the reality of what their situation is.
Absolutely. Like our team is really good to take some time. We have patience with clients. It's all about education. Education gets people into a path of winning, right? And be able to buy a home in today's environment. So that's what we're about, is creating that structure. So if you can't do it today, let's look at it and get you on a path that in 6 months or in 12 months, that option is available for you and you've got the right financing, the right property, the right metrics in place, the right savings for you so that you can really take advantage of getting the home of your dreams.
That's